Welcome to In Front of the Wave, brought to you by Wavefront Global Asset Management, an audio series breaking down complex financial concepts into clear and actionable insights. In today's episode, we're diving into the world of futures contracts, one of the most highly traded instruments in global financial markets and a vital tool for investors and businesses alike to manage risk and navigate the uncertainties of market movements. I am Patrick McDonald with Wavefront. Thanks for tuning in. Now let's dive in and try to help you understand futures and futures markets. To understand futures and futures markets, we need to start with the basics. A futures contract is essentially a standardized legal agreement to buy or sell an asset at a predetermined price at a specified time in the future. Think of it as a promissory note, a commitment to trade something at a future date. The beauty of these contracts is their standardization, meaning they come with specific terms that are uniform across the board, regardless of the asset involved. This standardization allows futures contracts to be easily traded on an exchange, making them highly liquid and accessible. Every futures contract contains 4 key elements: an asset, a quantity, an expiration date, and a price. Let's start the first element, the asset. This could be anything from a physical commodity like oil or gold to a financial instrument like a stock, bond, or currency. The diversity of assets available for futures contracts makes them incredibly versatile. Today, there are thousands of different types of futures contracts, covering virtually every asset class and sector imaginable. These contracts are traded across 30 major exchanges worldwide, with trillions of dollars changing hands every day. Whether you're looking to hedge against price fluctuations in energy, agriculture, metals, or even stock indices, there's likely a futures contract that fits your needs. Next element is the quantity. This refers to the amount of the asset being traded, and it's typically standardized depending on the asset type. For example, crude oil futures on the NYMEX are traded in lots of 1,000 barrels, while gold futures represent 100 troy ounces of gold. Some contracts, like the E-mini S&P 500 futures, represent 50 times the value of the S&P 500 index. While these figures may seem complex at first glance, they're designed to make trading more straightforward and to ensure that all participants in the market are on the same page. The third element is the expiration date. This is the when of the contract, the specific date when the asset will be delivered or settled. Expiration dates can vary widely. They could be a month from now, 3 months, 6 months, or even a year into the future. This flexibility allows both parties to plan and manage their positions accordingly. For example, consider an oil and gas company that knows its production levels for the next quarter. If the company is concerned about a potential drop in oil prices over the next 3 months, it might sell futures contracts at today's price to lock in its revenue. This provides the company with price certainty, protecting it from market fluctuations. On the other side, let's take an asset manager who believes the S&P 500 is poised to rise in the near future. The manager might buy S&P 500 futures to gain exposure to this expected upward movement. If their prediction is correct, they stand to profit from the increase in value by the time the contract expires. However, it's crucial to remember that when you enter into a futures contract, you're obligated to the terms. If you buy a futures contract for 1,000 barrels of oil with an expiration date of January 10, 2025, and hold it to expiration, you're on the hook to take delivery of those 1,000 barrels of oil on that date. This brings us to a very important concept in futures trading: rolling futures contracts. Today, an estimate 70 to 90% of global futures trading is done by investors that aren't interested in taking physical delivery of the underlying asset. Instead, they roll their positions before expiration, meaning they close out their current position and enter into a new contract with the later expiration date. This allows them to maintain their exposure to the asset without having to deal with the logistical complexities of actual delivery. We will dive into this and other important futures trading concepts in future episodes. So for now, let's move to the final element, the contract price. This is the predetermined price at which the asset will be bought or sold when the contract expires. Unlike the market price, which fluctuates continuously based on supply and demand, the contract price remains fixed from the moment the contract is created until it matures. The market prices, however, makes futures trading so dynamic. Just like stock prices, the market price of futures contracts can move up or down, reflecting changes in the value of the underlying asset. Traders can buy or sell these contracts on the open market, making profits or losses based on these fluctuations. Now let's bring this all to life with a practical example. Imagine you're a farmer growing wheat. Your crop will be ready for harvest in 6 months, but you're concerned that wheat prices might drop by then. To protect yourself, you enter into a futures contract with a buyer, agreeing that in 6 months, the buyer will purchase a specified quantity of your wheat at a set price. What's the advantage here? As the farmer, you gain certainty and security. No matter what happens to wheat prices in the market over the next 6 months, you know you have a guaranteed buyer who will pay the agreed upon price. For the buyer, there's potential for gain as well. If wheat prices rise by the time the contract expires, the buyer ends up paying less than the market rate, securing a good deal. Conversely, if prices fall, they might pay more than the market rate, but they've effectively managed their risk by locking in a price. Another critical aspect of futures contracts is their tradability. Before a contract expires, the buyer can sell it to another party in the open market, potentially profiting from favorable price movements. This liquidity and flexibility are what make futures contracts not only a risk management tool for hedgers, but also a speculative instrument for traders looking to capitalize on price changes. In conclusion, futures contracts are a cornerstone of modern finance. They provide a structured way to manage risk, secure pricing, and navigate the uncertainty of future market conditions. Whether you're an individual investor, a business owner, or a large institution, futures offer a versatile and powerful tool to help achieve financial objectives. That's all for today's episode of In Front of the Wave. We hope this discussion has helped you better understand the intricacies of futures contracts and their crucial role in the financial markets. If you have any questions or want to learn more, feel free to reach out. Until next time, stay informed and invest wisely.
This audio series is for informational purposes only and does not constitute financial, legal, or tax advice, nor is it an offer to buy or sell securities. Wavefront Global Asset Management Corporation is not liable for any decisions made based on the information provided in this series.